Let's start with the data of yesterday, the CPI, retail sales. This time yesterday, you thought that maybe retail sales might linger a little longer in our thinking. In the end, what did you make of the data set yesterday?
I don't know whether it's been a massive game changer. It's kind of kept us in that Goldilocks place that we've been for a while. I think the equities market rally can continue. I actually think the Kashkari's comments there were kind of spot on in terms of that we are seeing signs that consumers are starting to roll over. We're seeing signs that monetary policy is starting to crimp on the economy. We don't have enough evidence yet that's going to bring inflation down. That backdrop of kind of holding and waiting for now is good for stocks. And I do think that it's going to be hard for yields to go any higher. It's going to be hard for the dollar to go any higher because it's going to be, with that capping of yields and that re-leveraging into global stocks, it's an outflow out of the dollar. So I think they're the main backdrop themes, and I don't think they're changing because of the data yesterday.
OK, so it seems a bit Goldilocks. Certainly some voices on your Markets Live blog describing it as such, Mark. In terms of the surprises we've had here, the City Surprise Index now down in negative territory, but also on your blog, I'm reminded that this can be mean reverting, and so maybe we don't get used to that. It does seem as if a lot of the data has been softening out of the United States.
Absolutely, and I think we're getting closer to a turning point, this elusive turning point that's not been around for a while, but I still think that's a theme for a few months away. So I think the risks are growing for markets, but they're not getting closer in time. We are in that bad news is good news kind of regime for stocks at the moment. What is worrying is when, you kind of get to bad news is bad news, and then you get to this period where good news is even bad news. We're not close to that yet. So I think that overall, for the moment, even though the economy is slowing down, what people are saying is, OK, that's taking rate hikes off the table. But the fact is the consumer has kept spending until now. Earnings are still overall strong. That means the equity market will be supported for now. We're going to get to a harder dynamic, but I think we need to see clearer evidence that the US consumer is actually going off a cliff. We have some signs, but it's really hard to say it's happening just yet.